My own belief is that in the next 10 years, the purchasing power of the US dollar will again decline by 75%.
Sorry,
And
next 10 years, you said?
in the next 10 years.
Okay.
And my operating assumption is that gold will keep pace with the deterioration of the purchasing power of the US dollar. That would be a fourfold increase over 10 years.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The world economy has become a lot more uncertain in 2025. The shift away from decades of globalization towards nationalism and regional trading blocs has accelerated with the protectionist policies the new Trump administration is now pursuing. Gold has reacted to this uncertainty by soaring to new highs, and demand for other commodities is also in high flux right now. So, where is all this headed? And other opportunities the discerning investor can take advantage of amidst all this change? For answers, we're fortunate to be joined by Rick Rule, one of the world's greatest living natural resources investors and a heck of a gentleman to boot. Rick, thanks so much for joining us today.
Pleasure to be with you, Adam. After that sort of depressing introduction, it'll be an interesting discussion. Sadly, I think most of what you say is true. So let's get on with it and deal with it.
All right. Well, look, let's do that. Real quick at the start here, let me just note for your audience here, our audience here, that you and your organization are doing one of your boot camps this coming weekend, and it's a gold boot camp, which is why I wanted to just put on folks' radar here in case they're not able to make it through the entire interview. First off, folks, if you want to learn more about that, sign up for it. Just go to thoughtfulmoney.com/rule bootcamp. But Rick, this is a part two. So what did you guys discuss in part one, and what are you going to dive into here in part two of the boot camp?
Part one was, first of all, about the reasons why one owns gold, what part it plays in the portfolio, who should own gold and why. And then part one dealt with buying physical gold and physical gold surrogates, things like gold-denominated ETFs, Perth Mint certificates, the exchange-traded Sprott physical gold trusts, how to own and store physical gold. In my experience, Adam, precious metals bull markets follow a predictable path. The front end of a gold bull market happens around the physical. When the price momentum in the physical establishes the narrative in people's minds, they move to the equities. They don't abandon gold, but they allocate more capital to the equities. But they start with the biggest and the best equities first. And finally, they move to the smaller equities. So part two is about gold equity investments around the biggest and the best gold companies in the world. The big royalty companies, the Franco-Nevadas, the Wheaton Precious, the big producers, the ultra high quality, smaller producers that will likely be consolidated by the big guys. This is about investment in gold equities. Part three will be speculation in gold equities. The gold juniors, for the people who are willing to tolerate volatility, willing to tolerate risk, willing to do real work and try to generate alpha. This part will be around the beta in gold equities. And this is a very worthwhile topic. If one looks at a chart of the gold equities represented as an example by the XAU, what one sees is that in gold bull markets, median returns on equity exceed 250 or 300%. And the idea that over 4 or 5 years, you can enjoy 200, 300%, particularly in equity markets where turmoil is reducing your returns in other parts of your portfolio. This is a wonderful alternative. If you learn how, and if you know enough about the underlying premise, that you have the courage and the patience to stay the trade, given all the volatility that we're likely to experience in the next 4 or 5 years. So that's what this is about.
Okay, well, very topical, and we're going to talk about gold and gold's prospects here in a bit. We'll also talk at a high level about the miners, and if we've got time, we'll touch on silver too. But your boot camp, Rick, just to make sure I and the viewers understand, gets real specific, right? I mean, you'll go into particular companies and talk about pros, cons, and investing strategies, right?
Yeah, let me talk about the boot camps a little bit. We've done probably 15 of them. They are 8 hour long online discussions. So this is not a place for a tourist. For somebody who buys the Sunday paper to do the crossword puzzles, don't come. We're going to give you 8 hours with company specifics, with technique. We will have people like John Hathaway, who's been an institutional investor in gold stocks for 45 years. Adrian Day, a relative newcomer. He's only done it for 40 years. Joe Mazumdar, who's an absolutely world-class geologist. Importantly, uh, because we're going to give you more information in 8 hours than you can absorb in 8 hours, you will have access to the recordings of the boot camp for a year because a lot of the information is timeless. And if you have a life, which most of your listeners do, other things will come to occupy your mind and you will need to return to the lessons in the boot camp. In addition to that, there will be an ongoing discussion group about the boot camp at the Rule Classroom, which is free, so that you can compare notes with other investors for a year. The final thing you need to know about this educational product is like every other investment education product I've offered over 30 years, this comes with an absolute money back guarantee. If you spend 8 hours of your life and pay me the $99 tuition and think you didn't get $99 worth, I'll give it back. So, from a financial point of view, this transaction is completely riskless, with the caveat that we're going to work you very hard for 8 hours, and you'll probably need to watch the tapes one or two more times in the course of a year. So, really, you're looking at a 20-hour expenditure in time and effort. The potential payoff, if you look at the history of gold bull markets going back 50 years, is extraordinary. It's an investment in how to participate in an asset class whose time I believe has come.
All right, and the value from my perspective, Rick, it isn't just learning from greats like you and John and Adrian and other folks you mentioned, and the opportunity that the market may be offering here, right? If we get into a true bull market for these things. But the benefit is also in the saving of the common mistakes that people who are new to the space make, right? Highly volatile. There's a lot of things you got to understand about these companies. If you just come in and try to wing it, it's a fast way to get separated from your money, right? So leveraging the expertise of the greats here, a huge benefit for folks. Okay, well, look, folks, we'll mention this again at the end of this discussion, but let's get into the meat of the conversation here. Just again, if this boot camp is sounding of great interest to you, just go to thoughtfulmoney.com/rule bootcamp and you'll go to the registration page and can learn more about the event. All right, Rick. So, like I said in the intro, a lot has happened since you were on this program last. Let's start with this move of the world away from globalization towards more nationalism and regional trading blocks. What impact do you see this having on the demand for natural resources?
Well, two different impacts, one positive, one negative. The negative one is the easiest to put your hands on. Well, not just resource nationalism, but nationalism itself, the restraint of free trade, the restraint of the free movement of goods and capital across markets makes everyone poorer. You're seeing a response in the oil price and the copper price right now. We're seeing a slowdown in economic activity in real time, which has led to lower real commodity prices in the near term. In terms of the price of natural resource assets, the exact opposite is taking place because the world is beginning to develop itself into geopolitical trade blocs, which are competing with each other for access to resources. Mm-hmm. What the Chinese are doing, as an example, around the world, where the power of the Chinese state is used to further private Chinese economic interests in acquiring oil and gas assets and mining assets. What the Chinese are doing is the same thing the United States did in the 1950s, the same thing the European community did in the 70s, the same thing the Japanese, pardon me, in the 60s, the same thing the Japanese did in the 70s. The Chinese aren't doing anything that we didn't do ourselves in the 1950s. They took a page from our playbook, but there's competition now. What that means is that, as an example, in the rare earths business or the antimony business or the tungsten business, businesses that are controlled by the Chinese, assets that fall outside of the purview of the Chinese have suddenly become very attractive to the Koreans, to the Japanese, to the Europeans, to the Americans, and eye-popping multiples are being paid to
Hmm.
acquire production capability that isn't Chinese dependent. By contrast, in commodities that China is desperately short of and in need of greater supplies, the uranium business, the oil and gas business, the copper business, the Chinese are paying truly spectacular multiples or offering credit to Western producers for construction finance that have the effect of being cheap equity. The upshot of all this is that there will be challenges and opportunities associated with globalization. And investors are going to have to understand, or at least form an opinion, about the impact of this macro on each separate company's opportunity set to make money. Without the ability to do this, you're going to be challenged. The game is becoming rapidly different. And while it is probable that with effort, one can develop a reasonably accurate roadmap, not developing that roadmap becomes fatal to people. I think the other thing that we have to understand, Adam, is that all of our societies going back 40 years have underinvested in productive capacity around natural resources.
Right.
We have lived off the capital investments that we made in the 60s and the 70s and the 80s. The decade of the 70s, with the price explosion in natural resources, caused an investment boom. And we have lived off the proceeds, the discoveries made in that boom for 40 years. But that boom's run out. We haven't made sufficient exploration or sustaining capital investments in the copper business, in the oil and gas business, in a whole bunch of businesses. And those chickens are coming home to roost. That will have important impacts in geopolitics as nation blocks compete for resources. It'll have important impacts in that the structural costs of commodities will inevitably go up as there are shortages. And it will have dramatic impacts for natural resource investors as investors begin to separate the companies that have adequate resource bases for the next 20 years from those who don't.
Okay, and you might have just answered my next question here, but how long do you expect that period of, greater demand than supply for natural resources to last? The rest of our lifetimes, the next 5 years, like?
Well, the question then becomes, Adam, your lifetime or mine? I'm a bit older than you.
You're a bit
Certainly,
older than me, but I'm not a spring chicken either.
certainly for the balance of my lifetime, I think a different question on a net present value basis, and the investor himself is going to have to answer this question. In the near term, if we have a recession as a consequence of globalization or for some other reason, you can have reduced supplies around resources, which we absolutely positively will have.
Mhm.
If you reduce demand, you don't move the price. So the impact of supply and demand in the next 2 or 3 years means that you have to consider the probability of a recession. A recession doesn't eliminate the supply crunch. It delays the price
Right.
impact of the supply crunch. And I think it's important for your listeners to understand that they need to coordinate their strategy and their tactics if they are investing in resources or some other business that has a 5 or 6 year time frame. Uh, then they need to have 5 or 6 year tactics. There are a lot of investors who get the copper thesis right. They understand, as an example, that we've underinvested in copper for 30 years. And as the world grows and as we go more electric, we need more copper. That's a 5 year thesis. Those same investors, Adam, often have trauma holding stock over a long weekend. And if you combine a 3 month or a 6 month tactic with a 5 year strategy, The outcome is inevitably very, very, very bad. And part of the reason why I enjoy doing discussions like this is helping people match their strategies, which are usually right, with their tactics, which are often wrong.
Hence the boot camps, actually, the value of the boot camps. Okay, great. All right, so that's the big macro context here. You gave a little foreshadowing of this, but what's your assessment so far of the economic policies of the new Trump administration and the world's reaction to them?
Uh, Sadly, I would say that the policies were predictable for anybody who had read The Art of the Deal. Uh,
Or
this
listen to Trump during his campaign. I mean, he was pretty transparent.
this president is extremely transactional. Uh, and what that means is that for an investor or a foreign partner or anybody, the idea that you can find some policy or even ideological consistency in the proposals is wrong. Uh, the tariffs, as an example, uh, while the policy promise is the same, really are transactional. They're a way to punish enemies and reward friends. And it's very difficult to understand how that's going to play out, except for politically. Adam, if you and I were to author a free trade agreement, we could do it in a paragraph. There will be no legal or institutional constraints to the voluntary purchase or sale of goods and services between Rick Rule and Adam Taggart for the duration of this instrument. Our last free trade agreement, NAFTA, consumed 3,600 pages. According to David Stockman, the current, I don't know what you would call it, the current protocols around Trump's trade agreements now exceed 2,000 pages. The devil, of course, will be in the details, and that uncertainty won't serve anyone well. So I'm unfortunately pessimistic about the outlook for American economic performance and global wealth as a consequence of Mr. Trump's policies. I also need to say, and by the way, I was not a Biden supporter. I'm not a Trump supporter. I was not a Bush supporter. I was not a Clinton supporter. I was not an Obama supporter. I'm an Adam Taggart supporter.
Oh,
I
thank you, my
believe
friend.
in the free interchange of goods and services by people who create value. End of sentence. That brings me to DOGE, the Department of Government Efficiency. A lot of people, many of whom are former clients of mine, are extremely encouraged about Mr. Trump and Mr. Musk's rhetoric around the Department of Government Efficiency. I'm a personal friend of David Stockman, who will be, by the way, pardon the commercial, a keynote speaker at my upcoming Natural Resources Investment Symposium. And he ran the original Department of Government Efficiency, something called the Office of Management and Budget in the Reagan administration.
Yep.
He wrote a book called The Triumph of Politics, which described the derailment of the Reagan Revolution within 6 months of Reagan taking office. Reagan, you may recall, didn't win the election by an eyelash. He won by a landslide. He had a broad mandate to reduce the size of government. And politicians, Democratic and Republican, derailed the Reagan Revolution within 6 months. I'm afraid that the outlook for the Department of Government Efficiency is at least as dire. If this administration had a lot of faith in the Department of Government Efficiency, why would they pass a continuing resolution to raise the debt ceiling?
Right.
And why would the projected deficit be the fourth largest in recorded history? So I think that investors and voters who were attracted by the Trump rhetoric, or even merely disgusted by the Biden performance, need to take a look at the next 4 years in the context of the probability of a good outcome occurring as a consequence of either tariffs or the Department of Government Efficiency. And I would say, from my own point of view, on both scores, things might not get worse than they have been, but they certainly won't get better. And people need to accommodate their own savings and spending and investing habits to the reality of the next 4 years and not to the rhetoric of the Trump administration.
Okay. So let me ask you this. Another pillar of the current administration's economic policies is deregulation. And specifically, or particularly to help with resource exploration and development, right? The whole drill baby drill, but I've heard the Secretary of the Interior say, hey, it's as much or not even more so mine baby mine. And just as an example, in our previous interviews we've done over the years, Rick, if I remember correctly, one of the examples you've held up of just how government bureaucracy can get in the way of a great opportunity, you've talked about the Resolution mine,
Yes.
copper mine, and I just read recently that apparently they have cut that red tape and are potentially setting things in motion to get that mine operational.
In this regard, there is a lot of good that Trump can do because most of the regulatory impediments have been done by executive order, which is to say they weren't approved congressionally. They didn't go through the legislative process. And our current political system allows executive orders to be undone by executive order.
Mhm.
And there has already been an enormous thaw in the de facto regulation of natural gas liquefaction plants, natural gas storage, natural gas transmission. There has already been at the EPA and the Department of Energy an enormous thawing of the backlog of unapproved projects. It isn't that the EPA or the Department of Energy disapproved of projects. It's just that when you set a project in for approval, you were met with a decade of silence.
Right.
That has already changed and changed for the better. And Mr. Trump has said that if large resource projects are brought to his attention, that he personally will intercede where an executive order can unfreeze the project. Now, it's worth noting that the resolution project has problems at the state level and the local level too. It is on government land, so there is a government nexus that extends to state and local. And there are legal challenges around the project, brought in particular not just by the environmental community, but also by the local Apache tribe.
Mhm.
I have some experience with local and indigenous opposition to resource projects. And often, if the government is willing to share some of the social take, which is to say some of the royalty, some of the fee, and some of the tax with the impacted community, that the impacted community's calculus around the cost and
Yes.
the benefit of the project changes.
Yeah.
Uh, should Mr. Trump wish, he could appoint me for $1 to act as an intermediary between all partners in the resolution project. And I'm highly confident that I could get all parties on side in 6 months.
Well, hopefully someone from the administration is watching this, Rick, and you get a call soon after this video airs. Real quickly, just for the folks that might not have heard about the resolution mine, can you just explain why that's such an interesting opportunity?
Yeah, the resolution deposit is one of the largest undeveloped copper deposits in the world. And it's in a great place. It's in the Central Valley of Arizona. Uh, to the north of it, it's got a copper mine. To the south of it, it's got a copper mine. A highway goes past it, railroads go past it, power goes to it, water's there. There's communities that surround it that have great human resources, which is to say, copper miners. It's 1.5 billion tons of ore running over 1.5% copper. To put that in reference, the average mine grade of copper worldwide is less than 0.5%. So it's 3 times the average grade worldwide. It's in a jurisdiction, Arizona, where they mine copper. There's a great regulatory environment. There's a great human environment. And the damn thing has been stuck in permitting for 26, now going on 27 years. No jobs, no copper, no tax revenue. Um, a true challenge. A true challenge. This mine has been subjected to environmental scrutiny of a type that defies description. I'm not trying to say, by the way, that there won't be a big hole in the ground. There will be. It won't be an open pit copper mine. It would be a sublevel block caving mine, but there will be surface subsidence. There will be some disruption of groundwater. All of this can be mitigated. I mean, understand that this is a mine that will generate a couple $1 million in surplus cash flow per day. There's a lot of money to go around.
Lot of money to go around, and so let's use this as an example of a larger opportunity. So in the future, where countries are maybe now competing a little bit more directly than they were during the era of globalization, um, these strategic assets, enable America to pursue big national priorities without having to depend on other countries. So, for example, if we really need to rebuild our energy grid, right, to electrify it, not just for transportation, but for AI and all that, here's a great way to get a whole bunch of copper domestically and not have to worry about it. Now we could do the same thing with, oil and natural gas, and that's the whole drill baby drill and mine baby mine. So you've got that opportunity. And I think, could be wrong, but I think part of the trade kerfuffle that's going on right now, one of the bargaining chips that's being used there in the negotiations is oh, hey, look, we'll take off some of those nasty penalties we were going to put on you, but you're A, going to bring your tariffs down a bit, and B, let's strike a deal where you get access to cheap American natural gas. We start bringing that to you, right? So is there sort of a beneficial double whammy here to take much better advantage of the resources we have at home for our own internal use, and then use them internationally to get even tighter trade relationships with the countries we care about?
There certainly is the opportunity for that. You and I talked about a year and a half ago about natural gas on your program. I don't know if you remember that,
I do.
but I pointed out that U.S. natural gas at that point in time, when it was in oversupply from oil drilling, was selling for about $1 per million BTU in Midland. And that same gas in Tokyo or Rotterdam or Shanghai was selling for $12 per million BTU. For reference, it took about $1.50 or $2 per million BTU to get it there. There was an arbitrage. That arbitrage has begun to tighten up. We're getting $3.50 per million BTU now, which is something that you and I talked about, that the cure for low prices was low prices.
Right.
But something else has happened. People who use natural gas in industrial applications, in particular German fabricators, have relocated their processing facilities from Germany to the U.S. Gulf Coast, to the U.S. East Coast. The availability of a lot of natural gas in the United States and the access which Trump could facilitate to Canadian natural gas means that for people who use a lot of natural gas, the single best place in the world to locate their producing infrastructure, perhaps after Qatar, is the United States.
Which Trump would love, right?
Which Trump would love and we should love. And I will say, for the Trump administration, there has been an immediate difference in permitting natural gas gathering systems, in permitting natural gas storage facilities, in permitting natural gas transmission systems, in permitting natural gas liquefaction plants. In that sense, his administration has done a great job. And his administration has reached out to the domestic uranium industry, myself included, and said, we're not going to tell you how we can help. We want you to tell us how we can help.
Mm-hmm.
If it has to do with undoing executive orders that were put in place during prior administrations, we can do that, and we can do it very, very, very quickly. But be prepared to make and defend your case.
Okay, so where I'm going with this, and folks, we are going to talk about gold and a few other things, Rick's thoughts on those in just a minute. But in the natural resources space, there's deposits all over the world, right, that investors can participate in. But you have country risk, right? And I guess my question for you, Rick, is what's going on right now potentially laying the seeds for greater opportunity for U.S. domestic producers so that investors might have more and better opportunities domestically to take advantage of than they otherwise would have, and they can do that without taking additional country risk?
I personally, in my portfolio, have learned that I need to favor taking political risk over facing taking technical risk. In other words, a high quality deposit in Chile is better than a marginal deposit or a median deposit in the United States.
Okay.
What has happened is that I used to assign the US a political risk premium. In the mining business, I consider the United States to be a more politicized and hence higher risky jurisdiction than others. And I have been able to reduce the political risk premium that I charge myself in analyzing US projects. A different example, Adam, was the Antler project in central Alaska, a very, very high quality copper project. It had the assent of indigenous people, which is important. It had the assent of the state of Alaska, an easily financeable project. Um, President Biden uh, took the application of the state of Alaska and the application of the company for the construction, the permitting and construction of an access road, and denied it by executive decree. That made me look at the United States as a riskier jurisdiction.
Hmm.
This wasn't an action that took place according to the rule of law in the courts or in the legislature. This was President Biden reacting to pressure that he felt from some elements of the environmental community that overrode uh, the environmental decisions made by the state of Alaska and the preference of the indigenous people of that part of Alaska expressed by their support of the project. So that's a long-winded way of saying that one thing that the Trump administration appears to be willing to do right is reduce the level of political risk in the United States. I still wouldn't describe the United States as a low risk jurisdiction. I would describe it as a high risk jurisdiction in the mining business, but it's becoming rapidly less so.
All right, so it's becoming a lower high risk
Yeah.
environment, so I take your answer as kind of a guarded yes to my question about opportunities for domestic investors, U.S. investors domestically is getting better, and this seems to be pretty across the spectrum, right? It's energy, everything from
Yep.
gas to oil to uranium, right? It's mining, base metals, precious metals. So, I mean, I guess maybe we can kind of cross our fingers and as natural resource investors, and just hope that momentum continues.
I would say that those investors need to look, yes, the circumstances improving at the federal level. Understanding we don't know what happens 4 years from now, and mining's a long-term business. But let's
Yeah,
throw that aside. It's getting better.
right. Because
Uh,
executive orders could just undo
yeah,
everything that Trump's doing. Yeah.
yeah. Investors then need to look at the state level because regulation in the United States is tripartite, federal, state, and local. There are some states that are good to invest in from an extractive industry viewpoint. They are Texas, Wyoming, Nevada, and Alaska. Every other state has caveats. There are some, like Utah and Idaho, that are improving. But once investors have made the decision that the United States is off the no-go list, then they need to decide what states are on the go list. And the go list currently is Texas, Wyoming, Nevada, and Alaska.
Okay. Thank you, Rick. These are like pearls of wisdom that, of course, you've learned the hard way over the course of your long career that you're just sharing with folks. So that's really very generous of you. All right, let me get into a couple of. I'm just looking at the time here and realizing that I could go another 3 hours with you, so I got to get a little more concise here. Um, So your boot camp that's coming up is about gold. I mentioned in the intro here that, gold has roared to new highs over 2025. In your mind, what has been driving the demand for gold? What's been catapulting it here?
First of all, it was oversold. It was too cheap. So the first thing that happened with gold is we got a dead cat bounce. In the period 1982 to 2022, arguably, non-prudent investors didn't need gold. But when people said to me, including on your show a couple of years ago, when's gold going to move? I said, well, I think it's going to move in 2000. In other words, 20 years ago, the price of gold then was 250 bucks an ounce. Now it's
Right.
what, 3,500, 3,400 bucks an ounce. So it's
Yeah.
moved 12-fold already. Then people say, well, is it over? Have I missed it? And to them, I would answer that gold really moves when people are concerned about the maintenance of their purchasing power in fiat denominated instruments. And I think that fear is very much alive.
Yeah. We're definitely
Our
burned from the cost of living increase that we've seen, right? So,
That's the most important thing. The interplay between the cost of living increase and interest rates. If you are somebody who believes that the CPI is a good indicator of the deterioration of the purchasing power of your savings, you don't need to buy gold. But the people who construct the CPI don't shop where I shop, and they don't
right.
shop for the things that I shop for. And the CPI doesn't include tax. When I look at the basket of goods and services that I buy, and I'm a cranky, old, fat, rich guy. I don't buy much. But the basket of goods and services I buy suggests to me that in the period 2020 to 2025, that the deterioration of the purchasing power of my savings was between 7.5% and 8%.
Mhm.
Look at gasoline, look at energy, look at health insurance, look at health care, look at groceries. The idea that my purchasing power has declined by 2.5% compounded for 5 years is stupid. It's
Yeah.
insane. If you believe, like I believe, that your purchasing power is declining at 7.5% or 8% a year, and you juxtapose that with the interest that you receive on a US 10-year Treasury, the world's benchmark savings instrument, that suggests that you lose 3% of your purchasing power every year for 10 years. There's no more valid reason I can think of to be concerned about the maintenance of my purchasing power than an absolute guarantee that in conventional savings instruments, I'm going to lose 3% a year compounded for 10 years. It means I'm going to be 35% poorer 10 years from now.
In a decade, yeah.
And am I concerned about that? Hell yes. I can do arithmetic. People asked me about 3 weeks ago on my own podcast. They said, Rick, you're a broken record. You're a one-way street. What would cause you to sell your gold? I said, that's easy. Easy. A balanced federal budget, a fiscal plan that accommodates $100 trillion in net present value of unfunded entitlement liabilities. By the way, that number is not from a fat, cranky, bald libertarian, Rick Rule. It's from the Congressional Budget Office. The net present value of unfunded entitlement liabilities in the United States is $100 trillion. So, a balanced budget, a fiscal plan that deals with unfunded entitlement liabilities, and positive real interest rates, which is to say an interest yield on the US 10-year Treasury that was greater than the deterioration of the purchasing power of the US dollar.
Right. So not
I think
not real based on the CPI, but real based on people's lived experience. Yeah.
if the real deterioration, by the way, shadow stats, John Williams says that inflation is running at 12%.
Hmm.
Uh, that number is not a number I need to prove my point. My point being that until those three criterion are met, that the reasons to own gold is in place. What I see in front of us, Adam, particularly with the unwinding of $100 trillion in entitlement liabilities, is a return to the 70s. I
The
see us,
stagflation of the 70s.
I see us honoring the nominal value of our entitlement liabilities by inflating away the net present value.
Yeah.
The Office of Management and Budget calculated that in the decade of the 1970s, the US dollar for US dollar consumers lost 75% of its purchasing power. This isn't my number, this is the government's number. In that same period, the gold price ran 30-fold. Now, admittedly, a third of that was gold catching up, with price controls.
Right, because it had been priced at what, $35 an ounce for decades? Yeah.
My own belief is that in the next 10 years, the purchasing power of the US dollar will again decline by 75%.
Sorry,
And
next 10 years, you said?
in the next 10 years.
Okay.
And my operating assumption is that gold will keep pace with the deterioration of the purchasing power of the US dollar. That would be a fourfold increase over 10 years. Could it be threefold? Sure, I don't know. What I do know is that holding a relatively small proportion of my portfolio in gold and gold stocks, I hedge against a lot of sin elsewhere in my portfolio, particularly in my bond portfolio. A circumstance where the purchasing power of the dollar declines by 75% absolutely massacres a long bond portfolio.
Yeah.
It doesn't hurt it, it obliterates it.
And you, just so you know, Rick, a growing number of people who I'm interviewing on this channel are making similar observations.
It's just arithmetic. It's not narrative.
Right.
We had a period 1982 to 2022 where real and nominal interest rates were coming down. That's over. This is just arithmetic. This is not narrative.
Right. And it is basically, you're expecting that movie just in reverse. Yeah.
Yep. Moving on to the boot camp, we've seen a pretty good move in gold. And traditionally, as we discussed earlier in the program, when the precious metals narrative gets established by gold, gold moves first. After a period in time, the higher gold prices means that gold mining companies' cash flow increases as the selling price of their product increases faster than the cost to produce it increases. And that rising cash flow and increasing investor confidence in the gold price means that the gold stocks play catch up. We've just started to see that in the last 14 weeks. Very high quality gold stocks, Silver Wheaton or Wheaton Precious, which we talked about in your show a year ago, Agnico Eagle, which we talked about on your show a year ago. Those companies are up 50 or 60%. Investors are asking if that's over. If past is prologue, if you look back to the period of the 1970s, the early part of the 1990s, or the period 2000 to 2006, the answer to that is clearly no. In a gold bull market, the best of the best rise 250 or 300% peak to trough. Then, as the narrative begins to be proven in the best of the gold mining companies, valuation arbitrage, begins to pull generalist investors' money into the rest of the gold mining industry. And ultimately, anticipating your question, the last mover in precious metals is silver. When the generalist investor comes down into the precious metal space, attracted by price momentum, perhaps because of the lower unit cost, or perhaps because of its reputation for volatility, upside volatility, or perhaps both, silver moves last. But it moves furthest and it moves the fastest when it moves. So I would ask your listeners to refresh their memory with regards to history. Look at prior gold bull markets as to why they occurred, and ask themselves whether the circumstances that they see augurs well for a new precious metals market. If the answer is yes, think about how bullion might perform in their portfolio as a hedge against other asset classes. Think about how the best gold stocks, the subject of our upcoming boot camp, perform in a gold bull market and whether or not those are appropriate. Think then, because our third boot camp will be speculative gold stocks, about what happens when market leadership changes to them And then finally study history and think about the most volatile of all precious metals asset classes, which is silver and high quality silver stocks.
All right, Rick, that's so intuitive for folks to understand the way that you laid it out there. And if I took my good notes here, um, the quality miners are, even though they've started moving, they're really only about a fifth of the way through the type of move you would expect, right? If they're up 50%, but they typically go up 250 to 300%. So the way I sort of think about this, and you tell me if this is a poor analogy, the precious metals market is like a whip, and gold bullion is the handle of the whip, right?
Correct.
It moves first, but it moves the least, right? And then the rest of the whip catches up, and silver obviously is the tip of the whip there, which takes the longest to move, but then when it does move, it moves the fastest, right? You get that crack.
Adam, that's absolutely a great visual. And the truth is, people, you will not need Rick Rule on your program to define when silver moves. Those moves are dramatic.
Okay, yeah, no one will be questioning it. We'll just see it happen, right? Yeah.
You don't need to think, you just need to look then.
Let me ask you this about silver. So first off, on the miners, folks, highly recommend, if you're looking to play this, go attend Rick's boot camps. They're what, $99? I mean, a tiny price for the potential of money that can be made here. So you can make smart decisions in those areas. Um, Presumably, Rick, at some point, I imagine you may run boot camps in the future saying, hey, the miners have moved so much. We're going to talk about strategies for lightening up now.
Yeah.
With silver, I assume with gold, I believe you think gold still has further upside. Certainly, just as fiat currency loses its value, gold is going to go up in price just to maintain its relative position. And I imagine for gold, you probably have a philosophy of like, it's not really for speculation, at least not bullion, right? Like you might want to play the paper game a little bit, but your bullion, you kind of want to have a position that you hold for a long time. I'm curious with silver, if people for silver investments, when silver makes a big move, right, like that tip of the whip cracks, do you have a similar opinion with silver, or would you be like, nah, silver is more of a speculative asset. You should probably get rid of it now that the move's been made.
I'll get rid of mine. I bought silver to sell it.
Okay.
I bought gold to insure my portfolio and to be a form of liquidity, albeit volatile liquidity. For people who have a trading mindset, there are some people who bought gold at $2,000 because they thought it would go through three. Okay, they did it. Sell it. If you're a trader, by all means, if you bought it for a trade, you recognize your goal. Sell it. You have a, what, 40% move in 2 years? Look at other asset classes and think about where you did that. Other than cryptos, probably nowhere. So if you're a trader, sell it. I own silver to sell. I own physical silver to sell, and I will sell it at some point in time. I don't know where now. And I own a pretty good sized basket of silver stocks because my experience in past bull markets is that the gain that you get from decent quality but small silver stocks really defies description. They feel like the uranium penny dreadfuls. I don't have those with any expectation that they'll be sold by my estate. In other words, they won't survive me. I will sell them. My suspicion is that I'll sell that basket for 10 times or more what I paid for it. That type of return carries with it the promise of substantial volatility and substantial risk, which I recognize. For my gold, I would suspect that the balance of my gold, the balance of gold in my own portfolio, physical gold, will be sold by my estate.
Okay, great. And I think that's really helpful to help precious metals investors figure out what is the, kind of forever hold or long-term hold versus, what should you react to if the market rewards you, don't be an idiot, take it. Okay, so it's always so wonderful talking with you, Rick, and there's so many things I could go in. I did want to go through, energy and the base metals, but let me just ask you this. Beyond the precious metals right now, where else do you see attractive opportunities right now for the discerning natural resources investor?
If somebody has a 5-year time frame, the oil market the oil and gas market is insanely cheap, truly insanely cheap. Could it get cheaper? Absolutely. We're coming into an economic slowdown. Oil and gas is economically sensitive. Fewer buyers is hard on price. So in the near term, I think gold goes lower. Or, pardon me, oil goes lower. Having said that, I've been a fairly consistent buyer of Exxon the last 2 weeks. I'd like to buy a lot more, and I'm happy to see it go lower because my conviction is so high. Speculators can look at the Canadian oil and gas market because something terrible there just happened. They elected Mark Carney as prime minister. He has the same attitude towards energy as his predecessor, Mr. Trudeau. The difference is that Mr. Carney is capable. I would much rather an incapable foe like Trudeau than a capable foe like Carney. So there's real political risk associated with the Canadian oil and gas space. It's so cheap that I own it anyway. But other investors might want to think about that. But the oil and gas sector itself is insanely cheap on a 5-year basis. It doesn't mean that a year from now won't be cheaper than it is today. But the truth is that I don't live my life in 1-year increments. I live my life in 5 or 10-year increments. And while I might be unhappy with my Exxon ex dividend in a year, I'm going to be ecstatic in 5 years.
Okay, and so do you think the way to play it right now is the quality big producers? I've heard a lot of people talk about midstream
Yeah.
enterprise companies.
Most of your listeners aren't going to do the work that is required to go too far down the quality trail.
Mm-hmm.
There is more money to be made in a $500 million producer than there is in Exxon, but there is surer money to be made in Exxon without having to do any work. I spend about an hour a month on each of my small cap stocks. I can do that because I don't have a life. I enjoy it. But for most of your listeners, they would be better off buying the highest quality companies in the sector and then going fishing or playing with their grandchildren.
Yeah. So it's funny. I guess it's not that different from the precious metals mining space, right?
Correct.
You know,
Correct.
can't really go wrong, or you'll go a lot less wrong,
Yep.
and still get some good upside going with the safe big
Yep.
majors. But if you do your homework, you can get much bigger returns. Okay, and then I guess I'll just ask this because we haven't really talked about it very much. What are your thoughts on uranium right now? I mean, it seems that the winds are continuing to blow in favor of nuclear, both domestically and internationally these days.
Yep.
Now, I know the price has kind of whipsawed around, so maybe it's not a great price right now. I don't know, but what are your thoughts on nuclear investing right now?
What's happened in the very near term is that the pace of Japanese restarts, while it's been politically favorable, the reality has been that the uptake in fuel consumption by the Japanese has been slower than many people, myself included, thought. And what that has meant is that Japanese inventories haven't been sold, but they've been leased, which is to say the Japanese have allowed other people to use the inventory in return for not money, but rather the pledge of the same quantity and quality of fuel coming back 3 or 4 years from now. So the increase in the spot price in uranium has been constrained by about 15 million pounds in surplus Japanese supply. Remember that prices are set on the balance between supply and demand,
Yep.
not the whole market. The structure, and we would need a much longer conversation with this. The structure of the uranium market is insanely bullish. Insanely bullish. The benefit of that structure will be felt by 10 or 12 companies rather than the whole 100 companies that exist in the space. So it's all about understanding the impact of construction finance, the term market, and individual issuers. It's important that one do the work in the uranium space. If one does the work in the uranium space, the next 5 years are going to be really pleasant.
Okay, so punchline is if you want to succeed in the uranium space, attend the next rural boot camp on uranium whenever you guys offer it.
Yeah, we will do another one. The last one was hugely successful. We did it at a point in time where the uranium spot price was $30 a pound. We said it had to go to 60. We were wrong and went to 85. That was stupidly beneficial. And it's time for us to do another one. That boot camp, by the way, was the best attended boot camp we had, thanks in no small measure to you. Over 5,000 people received an education on uranium in that boot camp.
No, that's just fantastic. All right. Well, look, I hate to say this, but we got to start wrapping up, Rick. Let me just ask you one last kind of crazy question, and I'm sure you could go long in it, but just give me your super quick thoughts. It seems that one of the countries with the most self-harming energy strategies is Germany.
Correct.
Do you see them eventually being forced to pivot and adopting, a more rational and self-beneficial policy, or are they going to just ride this thing into the ground?
I'm afraid more of the latter than the former. They're making noises about restarting their nuclear fleets, just they don't have too much to restart. And there appears to be, as long as there is some liquidity as opposed to solvency in the German state, those are different words, by the way, a belief in the continuation of an energy policy which favors, as an example, sun where the sun doesn't shine. Um, these policies are incredibly self-destructive. And unfortunately, the German voter, much like voters elsewhere, I guess, is more attracted to rhetoric than they are to arithmetic.
All
Uh,
right. Well, let's hope somehow saner thinking prevails, and if it does, we'll track it here. But I just got a message from Kelly
yep.
that you've got another obligation here, so I got to let you go, Rick. Real quick, just a reminder for folks: if you want to attend Rick's upcoming boot camp on gold, go to thoughtfulmoney.com/rule bootcamp. And very quickly before you go, Rick, just whatever you want to say about your upcoming symposium this summer.
Well, two things I want to talk about. Anybody who wants to personalize my thoughts on natural resources can go to ruleinvestmentmedia.com and for free, I'll evaluate their natural resource portfolios. List your stock at ruleinvestmentmedia.com, and I will grade it 1 to 10, 1 being best, 10 being worst. That's all free. Our biggest educational event of the year is the Natural Resources Investment Symposium, apparently in its 30th year this year, in Boca Raton, Florida, July 7 through 11. You can attend live in person in Boca or join a couple thousand people in 33 countries around the world, enjoying the conference on live stream in the comfort and convenience of your own home. In either case, you'll have access to the recordings of the entire proceedings for a year, which you will need. We're going to give you 50 hours of programming in 4 days, more than you can absorb. And like the boot camp, there's an absolute solid gold money back guarantee. If for any reason you don't think that we've earned the tuition that we've charged you, we will cheerfully refund your tuition. I'm proud to say in 30 years of making that offer, we've had to refund about 1/10 of 1% of the tuitions that we've charged. That notwithstanding, unlike any other investment conference in the world, this one comes with an absolute satisfaction guaranteed or money refunded guarantee.
All right. And folks, if you want to learn more, perhaps even sign up for the symposium, just go to thoughtfulmoney.com/rule symposium. And Rick, I'm really looking forward to it this year. I will be there this year, so I will see you next there in person. Rick, I got to let you go for Callie's sake, but thank you so much. It's been a great discussion.
Thank you, sir.
All right. Well, now's the time in the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. This week, I'm joined by senior partner Mike Preston. His colleague John Lodra has the week off. Mike, thanks so much for joining us.
Hello, Adam. Thank you. Glad to be here.
Good. Look, I imagine you were smiling through much of the Rick interview there because a lot of what he says, I think, echoes a lot of what I've heard you and John say in the past, especially with your guys' long-term outlook for precious metals, but also a lot of these key natural resources. So I'd like to get any key takeaways that you had, Mike. Though let me ask you to react to this one because I've been thinking about it since he mentioned it. So Rick was saying that he thinks on a true basis that the purchasing power of our fiat US dollar is losing about 7.5% of its purchasing power a year. And just doing some simple math, he came up with, well, then that means in the next decade, it's going to lose 75% of its purchasing power. It's obviously probably going to be worse than that using his math, just because you should be putting compounding in there, which would make it even greater than 75%. So basically, if you have a dollar today, it's going to be worth a quarter in 2035, right, in terms of purchasing power worth. So, when you kind of think about that, you're like, oh my gosh, right? So, maybe people in the comments can duke it out as to whether, they think Rick's spot on there, or they want to take the under or the over. But it's pretty sobering math. So, anyways, love to hear your reaction to that.
Yeah, Adam, I really enjoyed Rick's talk there. And those numbers are perhaps a bit high. Who really knows what the exact, loss of purchasing power, or AKA inflation rate is? The bond market thinks that over the next 30 years, it's somewhere around 2 or 3%. We'll see. A lot of people don't really agree with or even trust the government's calculation of inflation. Rick says 7.5. I'm not really sure where that number came from. It seems a little high to me, Adam, but
Yeah,
who
I think he
knows?
was sort of looking at some of the substitutes out there like shadow stats, which I'm doing this from memory, but I think he said pegs it more at like 10 to 12%. So then
Mhm.
you subtract from that the amount of uh, you think the treasury rate would be, and then you get a kind of a real 7.5% average annual decrease in purchasing power. So again, folks
Yeah,
folks
shadow
can
stats
debate it,
is
but I think anybody who's lived through the past couple of years, and in fact just the last year, right? I think the CPI calculation is what, around 3 for the past year, and I think most people would say, I look at my insurance costs. I look at what I'm paying at the grocery store. I look at what I've been paying until recently for gas and fueling my home. Um, it's felt like a lot more than that to most people. So I think a lot of people are probably saying, "Hey, yeah, Rick's number might not be on the nose, but it's not maybe that far."
Yeah, it strikes me as being slightly high. Furthermore, it kind of sounds like somewhere right in the middle of the government's official published 3% and shadow stats 12 to 15%. So, if I had to guess, I think the real inflation rate's somewhere around four something, low fours right now. It's still a big number, and it still highlights the problem of fiat currency. Something that we've been dealing with our whole lives. Adam, I think that you and I were born in the same year, way back in 1971, which seems further and further away as each year goes by. I just had another birthday, but our whole lives we've been watching inflation creep up, and the purchasing power of the dollar decline. It's become something accepted, and nobody really knows if there's an endpoint to any of this, right? Is there some kind of reset, monetization, start over type thing? It's almost unheard of and unthinkable to think of that in terms of the United States doing that. Other countries, much lesser in size and stature, have gone through that process. We can't imagine that happening here, nor do I think that it will likely happen completely during our lifetimes. But it's a real concern, and this is why people like Rick Rule believe so much in gold. It's why we think people should have some gold. There's all kinds of people out there that have been talking about this for 40 years now, at least going back to the 80s, or 50 years going back to the early 70s. So long story short, we agree that gold and silver and real assets, oil, gas, mining rights, land, income producing real estate, all of these things that are outside the far reaching hands of central bankers make a lot of sense. A lot of sense, not just gold and silver. So my reaction to all of that is have some real assets, things that you can touch, because we don't know how this thing is going to play out in the next bunch of years. Probably not going to be pretty from an inflation standpoint, ultimately.
Okay. And just cutting to the chase, if folks want guidance on ways in which the average investor can invest across all those asset classes, they can reach out and talk to you guys at New Harbor to hear your thoughts on strategies for that.
Absolutely. We can't promise to be right, but we will promise to give it our best shot in terms of our experience and our reaction based on your personal situation. We will do our best to guide you. We're happy to do that, whether you're a client or not. So please reach out.
Okay. So, we've talked in many videos past of New Harbor's positions in precious metals. I want to talk in a moment about energy as well, but I just want to get your reaction to my analogy that I used with Rick about thinking of the precious metals complex as kind of like a whip, right? Where the gold price moves first. It gets followed by the mining complex, which moves with a delay, but when it gets moving, it moves faster and further than the gold price does. And first it's the majors that move, and then it's the miners that move, or the junior miners that move. And then last on that whip is the tip of the whip, which is silver, which tends to, lag in terms of moving, but once it gets going, it moves real far, real fast, right? And Rick seemed to think that that was appropriate, but curious to hear, if you guys think that way, and if you are kind of playing, out your positions in the precious metal space, sort of according to that progression, that expected progression.
Yeah, I heard both you and Rick talk about a similar theory there, or similar construct. First, front end being the metal bullion. Secondly, the stocks, the miners. Thirdly, the juniors and the speculation. It sounds like both of you agreed, and both of you agreed that silver kind of is in that the tip of the whip phase at the very end as well. Silver comes last, and it's been really, really frustrating for people in the silver. It's in the silver trade. But yeah, I agree with you. That's how it's been in the past. And I can say that that's how I hope it plays out here. We can't really say more than hope for the tip of the whip phenomenon, because it hasn't happened yet. But that's what's happened to every other bull market in gold and silver and commodities, and even in general. So yeah, we certainly have seen the metal do really well. Gold is really sticky to the upside here, testing the all-time highs again. Miners have picked up the last couple of days. I'm happy to share some charts in a little bit. And but the juniors have done well in gold, but less so in silver, silver bullion, and silver miners. And so if the past is to be any guide, then we should see some major, major upside in silver. The silver to gold ratio is still hovering around 100 to 1. It's been 80 to 1 for the last year or two. And even that's a little elevated, because long-term average is more like 50 to 60. I might get some argument from people about that. But to me, eyeballing the charts, it looks like around 60. But even if we pulled back to 80 to 1, or 90 to 1, and gold stayed where it was, it's going to be a nice pop for silver. And silver's testing a triple top right around 35. It keeps going up to that area, 33 to 35. It's right up in there again, 33 and change. If it gets to 35 and punches through, that will break a triple top in silver. And with silver and gold, like we talked about many years ago, actually not many years ago, maybe 2 years ago, talked about the triple top in gold at around 2000. That broke through and launched. I would watch for silver to do the same.
So let me ask you this. So Rick had said that uh, the mining complex, the best miners, um, or the mining complex, I guess, usually goes up about 250 to 300% in a true gold mining bull market, right? And he'd said that the best miners have jumped about 50% so far, which, you do simple math, that means that if we are entering a true bull market for the miners, and no guarantee, but if we are, that there's still the majority of the run ahead of that. If they've done 50%, they're supposed to do 250 or 300. There's still 4 or 5 times left of appreciation left in the tank for the mining complex. So presumably, there's a lot of people that would love to get, 4 times their money in a relatively concentrated period of time in this sector. And look, I don't want to overpromise, and also this is a very volatile sector, so you got to be real careful as you invest here. But presumably that just says, look, there's still an awful lot of upside here in the mining complex. I know you guys are invested in the mining complex, so I'll let you comment any way, shape, or form you'd like to about how you're currently positioned for that. But before I ask you to do that, so if silver moves further and faster than everything else, then presumably silver should go up more than, 5 times from here, which is kind of a hard number to really get in your head. 5 times from here would be over 150 bucks an ounce for silver. Um, again, that's a hard thing to wrap your brain around. But I guess, Mike, people are waiting for silver to get back to 50 bucks an ounce. But do you think we'll see 100 bucks an ounce silver by the time this run is over?
I do think we'll see $100 an ounce silver, and I don't know when this run will be over. That's a hard thing to say. Gold and silver, particularly gold, has been in a bull run now for 4 or 5 years. In fact, I think maybe I'll bring up the charts so that we can share some of these charts. And I just typed in the gold chart or GLD. It's a proxy that we'll use to show you the gold price here. So here's the consolidation going back to the 2011 high on gold, and then essentially had a 10-year consolidation followed by a sideways handle of 2 to 3 years. And here's the old triple top that I mentioned in gold. 1, 2, 3. And that's right around $2,000 an ounce. If you remember, Adam, we were talking about it in here almost every week. And that was it was taken out here, and then we just launched. We're up at around $3,400 an ounce now. So this has been a massive move. And the question is, when does this end? The problem is we don't know. It is getting extended, I'll tell you that. A lot of clients and potential clients are asking about it. We're seeing just a lot of news about gold and miners. And if you look at the leaderboard and the momentum type growth names, a lot of those leaderboards are now populated by gold stocks. So that has me pause a little bit. But it's really early. We've been waiting years and years and years for gold to break out and miners to follow, and it's finally happening. So we don't want to be too early. We don't want to say, you got to get out, because picking a top is a fool's errand. All I can say is review your allocations, make sure you're not too overexposed. Make sure that you rebalance, make sure that you think about hedging from time to time. But I wouldn't say that we're anywhere near the top. So gold is here at around 3,400. I think that it's probably trying to reach that new range that we mentioned earlier a few weeks ago, 3,800 to 4,000 maybe by the end of the year. But silver, take a look at silver now.
Hey, real quick, Mike, before you move to silver, just real quick. So, one of the worries you have when you see a chart like this is, oh my gosh, has gold just gotten way ahead of itself here? And could there be, some pretty substantial reversion to the mean here? Which certainly could happen, right? Now, I think Rick's answer to that, because I more or less asked him this, was that, well, gold was just really undervalued. And this is more gold finding a truer baseline. So I don't think in his case he expects a massive retracement of this. And again, anything could happen, and that's why you want to take the steps that you just mentioned about, trimming your positions back and putting on hedges and all that type of stuff. But I guess what I want to say is if gold did revert to the mean heavily here, then we probably won't get, this massive whip action in the miners and in silver from here. But if gold even just hangs out here, let's just say it consolidates. Let's say the run peters out, but it can hang on to these levels here. We then really should see that whip action, because there's still a lot of room for those miners and silver to catch up to where gold is ratio-wise.
Yeah, and I don't have a silver to gold ratio chart handy, but it's 100 to 1, which is very, very extended. It hit 120 during the COVID lows, but 100 is very, very extended. I expect, maybe slash hope, that gold goes sideways here for a little while. Let me slow down the chart, go to, perhaps that's silver. Excuse me, let me go back to gold. Slow down the chart a little bit on the weekly, for instance. The weekly, as you can see, punched through here, and it's been bouncing around in this area. And so this would be between right now around 3,400. If we just held 3,400 or so for a few weeks or a few months and allowed silver the chance to catch up, let me show you silver here again. Silver on a weekly chart has just been going sideways really for about a year, and it's very puzzling. We go out to a monthly for a minute so you can see the big picture. Back here in 2011, silver hit 50. And this is what a lot of people are asking about. Why haven't we taken out the high in silver? Because we're way above the high in gold. And believe me, I'm disappointed too, like a lot of silver people are. But silver just acts differently. It always is the last historically to move. I believe that will be the case again. But in investing, that's what you have to do, is you've got to place your bets now based on what you think is going to happen. I believe that's what's going to happen. We broke out of this triangle here back in 23, and we moved higher. We're presently around 32 to 33. This is SLV, just for illustration purposes. Now, going back to the weekly chart, you can see what I'm talking about with the triple top a little bit more. This is 35 or so on spot, one touch, two touches. Then we had this big drop on the tariff news, and we're building this consolidation. You might even say it's a weekly handle. If we can get a big bar, what you're looking for is a big weekly bar like this green one or this green one back here. I'm expecting if we get that, that'll kick silver off into that new range. We break through 35, we could probably go up to 38 to 40. And then longer term, year plus, maybe we're looking at breaking that $50 high. All of that will be really good signs of that tip of the whip, speculative fervor. A lot of these juniors and silver companies will do fantastic during that time. I don't think investors have to try to play the game and every little bit of that. I think if you just stay invested in bullion and have some general exposure or exposure to beta, like Rick says, I think you'll do fine in this space.
All right, and then let me just move quickly over into oil and gas. In Rick's words, prices are insanely cheap right now. Though he says, look, they could get even more insanely cheap. So he's not necessarily saying the industry is going to turn around tomorrow. We just had a letter published by the CEO of Diamondback Energy, who basically said, look, the prospects for the industry here aren't looking great. Oil prices are low. That is just, provides a disincentive to go out and explore. Tariffs right now are actually making it more expensive for energy companies to do business, and their costs of production are going up. He mentioned that some of the key plays in the shale industry are starting to peak out. In fact, some are already past peak. So what he's basically saying is like, there's increased challenges to domestic production here, even though the new administration has said we want to do drill, baby, drill. But he's just basically like, right now the dynamics are is we don't have a lot of incentive to go out and drill cost-wise. But there's going to be if we're not exploring as much right now, and some of our existing wells are starting to peak out, at some point in time there's going to be a date here where we're going to have start to have more of a supply-demand imbalance, and prices are going to just structurally start going higher in this space. So he's kind of giving a warning to the country. I think what Rick would say is like, look, well then, you want to buy when there's blood on the streets. You want to buy right now when, prices are super low. And so are you guys seeing a similar opportunity? And if so, are you making your plays now, or are you waiting to see more sort of washout in the industry before you take bigger positions?
Yeah, Adam, thanks for the question. One thing that I kind of latched on to that Rich said, or Rick said, was that, just looking at my notes here, the best way to play the oil and gas, opportunity, and he thinks it's a very big opportunity, is to buy high quality and go fishing. I tend to agree with that for most investors. I think the space has a lot of macro potential, longer term. There's a lot of good reasons to be bullish oil, gas, and energy. And but the problem is this, and I think I'll just share a chart again here in a moment. The problem is this: there's some recessionary fears. We had the negative GDP print the other day. Oil is way down. Here's a chart of the oil ETF USO. It's down from 20 bucks or so in the last few months, and oil continues to plumb lows in the 60s. And there's recession fears because of that GDP print. And so oil does poorly in a recession. So that's really the big concern. But we like companies that are in the service industry, like, for instance, XES. But take a look at a daily chart of XES over the last year. This is the S&P Oil and Gas Equipment and Services ETF. These companies should do great in the paradigm, in the regime that Rick talks about. And so if you don't want to just buy quality and go fishing, just buy the whole sector and go fishing. But I have to admit, it's a bottom fish play. And so you've asked us, have we bought in here. We've owned XES in the past. We've owned the producers, which is XOP. We prefer the service companies because historically they do better than the commodity itself. So going back to XES, why won't we buy a chart like this usually? Because it's a bottom fish play, and we prefer to buy relative strength. So the people looking at the big macro picture that just want to buy and forget, I think you probably could buy something in this space, and something like in the service sector makes a lot of sense. But we're not going to buy until we see oil base out and break out to the upside. We're not going to buy this until we see it base out and break out to the upside. Let me show you how much this thing has come down. I mean, this is kind of crazy if you go to the monthly chart. Let's just go to
Oh
the
my
weekly
goodness.
chart. You know, and there may be some rejiggering of the the stocks in that ETF. So maybe the monthly chart isn't really that valid. But look at the weekly chart. It's basically gone from 100 to 50. Over the last year and a half. So it's lost half its value, and so it's really gone nowhere for a few years. I think it's probably a good bottom fish play for the people looking to nibble. We're not really bottom fishers. We'll wait for some kind of base and a breakout, and even if we buy higher up here, we're okay with it. I guess that's the best way that I can answer that.
Okay, so you're basically saying you're not so interested in trying to catch the falling knife, but you'll wait till you'll see the signs that a bottom is in, and still, you'll miss the absolute bottom, but hopefully you'll still get in early on the recovery rally.
That's just a stylistic thing. That's our style. But I happen to agree with Rick that there's a huge opportunity in gas, natural gas. We've got a ton of it in this country, and he said that it's probably the best place to invest in infrastructure here in this country. I think next to he might have mentioned somewhere in the Middle East, Dubai or something. But it's the United States. Here is a wonderful opportunity to invest in oil and gas infrastructure. Again, personally, we would wait for a base and a breakout, because when the investing public starts to wake up, the charts will start to move, the prices will start to move, and there could be years of appreciation from that point. So you don't have to pick the ultimate bottom in that space.
All right. And just to add to this, I was listening to a podcast yesterday, an interview of Secretary Burgum, Secretary of the Interior. He was being interviewed by one of the All In podcast guys, and just could not emphasize enough the importance of increasing America's energy production to America's key priorities going forward, and a huge one. I mean, there's lots of reasons for national security and affordability and all that type of stuff domestically, but a huge part of it is to really be competitive on the world stage, to remain competitive on the world stage. Energy is going to become an increasing weapon for that, both in terms of AI development, and in terms of who can power their economy, not depending upon other players. And so it's really clear that this administration is like laser focused on dramatically increasing America's energy production, not just in BTUs, but also just sort of measured in electrons that are going to power AI. So there's a big political tailwind behind this industry that is just beginning to ramp up here. Probably won't feel the effects, my guess, for another year or two in the market, but it is a big planned tailwind. So unless something happens to derail it, that's going to be something that's going to be propelling this industry higher too. All right. We only have a couple minutes left here, Mike, but let me just ask you a couple questions here before we wrap up. I think I asked this of Michael Leibowitz the other in our recent weekly market recap. So I wanted to ask it of you guys. I've heard you guys and some of the other advisors I've interviewed in this channel say, hey, look, we're really leaning into technical analysis right now more than normal because there's so much uncertainty going on the macro scale, which makes sense. The analogy you use is, hey, if you're a pilot and it's really cloudy, you're going to rely on your instrumentation more than you're going to rely on the windshield. But there are all these like non-market developments that are making it more complicated to fly just by the instruments alone. And one of the things that's just monkeying these markets around is headlines. right? And you just have no clue whether there's a Liberation Day announcement that surprises everybody with the crazy numbers that get put on the poster board that gets brought out there. Just last night, we had an announcement that China and the US are going to actually meet in a couple of days to discuss trade, whereas leading right up to that, it was, oh, nobody's talking to each other. So there are all these big news developments that kind of just grab the market's attention and sling it one way or the other way. Certainly, the Trump administration is doing that. I'm just gonna share this screen here from something we talked about right as we hopped on here, Mike. I guess in testimony today, Apple just announced that it's seeing a lot of uh, traffic that used to go to Google for search is now increasingly going to AI. And basically, like, it's recovered a tiny bit, but like 10% of Google's market value just evaporated in a matter of minutes, right? It's like $200 billion worth of market value gone, right? Just poof, right? And will this recover? I don't know. We'll see what happens. But the fact that you can have that big of a stock be that injured in such a short period of time by a breaking headline is kind of crazy. So my question to you is how do you guys, you and John, as capital managers, navigate a market that is so unpredictable right now that any kind of headline can cause dramatic damage or dramatic benefit out of nowhere?
It's not easy, Adam. Don't ever forget that we're in, or I would say to myself, because I can't tell you what to believe or the viewers what to believe, but I say to myself, don't forget that this is the end stage of this expansion to some extent. We think that we're in the last innings of this expansionary period, multi-decade expansionary period. We believe that we're building up to some major accident here. So don't be too aggressive. Don't be too much in individual stock names, for instance. We prefer to be in sectors, or basically in ETFs that will represent sectors. It allows us to be a little bit more nimble. It helps us avoid accidents like Google. This thing with Google is a perfect example. Like you said, just out of nowhere, a news headline comes out that says an Apple executive has testified that we see some evidence that people are using AI more than search engines. Well, guess how much Apple pays to Google for Google to be on iPhones as the search engine? $200 billion, funny enough, because $200 billion is what you said that was just erased in an instant. So the market just assumes, on a news headline that, hey, this is real and we're going to take $200 billion off the market cap, which is kind of crazy because, who's really surprised that AI long term is a threat to search engines? Nobody. So there's nothing new about this information. And, we're going to have to dig through it and the market's going to have to dig through it. My guess is this is probably a short-term opportunity in Google, for those that want to buy it. But, longer term, the market faces a lot of risk. So how do you manage that? We do lean into our technicals. And because there's really no way to know everything in this environment. And we have what I would consider a pretty underweighted position in equities and have had for some time. We're presently at around 38 to 40%, more towards 38 because we just added a hedge the other day. And so that's really underweighted equities. And here we are saying that we're likely going to have some kind of move higher, maybe even a melt up. Well, that's okay. I think the investor and the professional has to make a conscious choice. Are you okay with missing out here? Because we're in an environment that's really crazy and there's a lot of game theory going on and a lot of guessing going on. But what you want to do is set your allocation to, that's the most important thing, to what you think you can handle. And then number two, make some decisions around that and hedges around that. And so the S&P, I'd be happy to share some charts of the S&P if you'd like, Adam. The S&P is at a critical juncture right here.
Yeah, bring it up real quick.
All right, so here's the daily chart of the S&P 500. 50-day moving average is the red one. 200-day moving average is the green one. Interesting enough, here, this is the so-called death cross that we had just about a month ago. And we're now flattening out, and this market is right here at 5630, right between the 50 and the 200. These are exponential moving averages, by the way, which is what we like to use. The 21-day moving average here is the pointing up. If we get a big day up here, and yesterday put this line in here at 5,700 or so. I think this is pretty key. We built a tight cup, consolidation, really steep drop and a steep rebound. In fact, one of the steepest, quickest drops going back decades, followed by a quick rebound. If we take out 5,700, this recent swing high, to me, that'll take out this little handle consolidation. It'll swing the 21-day up more vertical, and then the 50-day will start to come up and cross the 200-day. How crazy would it be if we had a death cross followed by a golden cross in such a short period of time? And yet that's what very well could happen. So we're back to all these levels, this resistance level of breakdown. All of the moving averages are converging. And to me, it looks like the market wants to go higher because all of our short-term indicators are very strongly positive here. Now, that is not a signal to go all in. I already told you that we're okay with the fact that we're underweight. But for those that have an allocation to equities, that are willing to try to, for lack of a better word, time the path a little bit, I think what's likely to happen is a breakout here and maybe a test of the highs and higher before we actually top out here. So critical juncture. If we start to break lower, I would say the critical low is the low of the last Tuesday. I think that was that negative GDP print around 5,400 on the downside and 5,700 on the upside. So that's a pretty tight range there, about 300 S&P points. Watch for a break out of this forming triangle. I think it breaks up, but I might be wrong. If it does, if you're short, you got to cover shorts there. Those that are looking to play the shorter term could add a little exposure there, but a pretty critical spot.
Okay, pretty critical spot, could go either way. So obviously it's worth monitoring really closely. We'll have you back on next week with your partner, John, Mike, to update us on where things look like they're headed from there. All
Great.
right, I have to wrap things up. So folks, if you enjoyed the conversation with Rick, would like to have Rick come back on again relatively soon to give us an update when he, sees additional trends that either validate or change his mind. Please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Obviously, if you'd like some help in preparing your portfolio, positioning your portfolio to take advantage of these trends that Rick was talking about, highly recommend you do so following the guidance of a good professional financial advisor, particularly one that has a lot of experience investing in the natural resources space. If you've got a good one who's helping you out with that, great, stick with them. But if you don't, or you just like a second opinion from one who meets that criteria, then consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money, perhaps even Mike and his team there at New Harbor Financial. To set up one of those consultations, just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations don't cost anything, but you'll get nice personalized guidance from these firms, and they'll reach out to you as soon as you fill out that form. Don't forget too about Rick's two upcoming events. If you want to attend his Gold Bootcamp this weekend, don't forget to go to thoughtfulmoney.com/rule bootcamp to sign up for that. And if you want to sign up for his annual symposium in Florida in June, just go to thoughtfulmoney.com/rule symposium. All right, Mike, thanks so much for joining us again this week. Things are getting real interesting. It'll be interesting to see what the technicals tell us next week, but appreciate you having come back on, and we'll see you next week.
All right. Thank you very much, Adam. Really appreciated hearing Rick speak and appreciated talking with you today and can't wait to talk to you again next week.
All right, thanks, buddy. Everybody else, thanks so much for watching.